What do I actually buy? That's the question. The pyramid is built, the routine is wired, the rules are set. And then the person opens a Fidelity or Schwab account, stares at the search bar, and freezes. Because nobody told them what to type into it. The debt was gone, the routine was running. The Roth IRA was open. And then she froze. Her name is Camille. She's a 30-year-old lab technician in Milwaukee earning about $54,000, and she'd followed every step in this series to the letter. Emergency fund in a Marcus high-yield account, credit card paid off, 401k enrolled with the employer match captured, Fidelity Roth IRA open, $200 a month automated. But the money was sitting in the Roth as cash, uninvested, because the next step required her to choose a fund. And the search bar on Fidelity returned over 10,000 results. She told me she sat with the app open on her lunch break for 3 days in a row and closed it every time without buying anything. 3 days of paralysis on an account that was losing purchasing power to inflation every hour it sat in cash. I'm Warren. This video exists to end that paralysis. 3 portfolios, 3 risk levels, exact ticker symbols, exact percentages, no menu, no decision tree, 1 answer per risk level and the reasoning behind each. But first, 3 things need to be cleared out of the way. 3 beliefs that keep people frozen, paying for advice they don't need, or worse, doing nothing at all. Myth 1. A financial advisor is required to invest properly. This is the most expensive myth in personal finance. The average financial advisor charges roughly 1% of assets under management per year. On a $500,000 portfolio, that's $5,000 annually. Over 30 years with compounding, that 1% fee consumes roughly $170,000 of the portfolio's growth. Not for better returns. Research from S&P Global's SPIVA scorecard, updated annually, shows that over any 15-year period, approximately 90% of actively managed funds underperform their benchmark index. The advisor picking funds doesn't beat the index. The client pays 1% per year for the privilege of underperformance. Camille doesn't need an advisor, she needs 3 ticker symbols in 15 minutes. Here's the nuance that matters. Some people genuinely benefit from an advisor. Complex estate planning, business owners with tax complications, high net worth individuals with multi-generational wealth transfer needs. For the vast majority of people building wealth from zero to their first few $100,000, an advisor adds cost without adding value. The 3-fund portfolio that this video will lay out costs 0.03% per year in fees. That's 3 cents per $100 invested. Compare that to $1 per 100 from the advisor. The math isn't ambiguous. Myth 2. Individual stock picking is the path to wealth. This belief is fueled by social media, by stories of early Tesla investors and Nvidia buyers, by Robinhood's gamified interface that makes trading feel like winning. The data tells a different story. Over 20-year periods, the S&P 500 has outperformed roughly 93% of large-cap active fund managers. Those are professionals with Bloomberg terminals, research teams, quantitative models, and decades of experience. They can't beat the index consistently. The idea that a retail investor checking stocks on a phone during a commute will do better is not supported by any credible data set. If you've ever felt the pull to buy a single stock because someone on social media posted a screenshot of their gains, this is the correction. The screenshot shows the winner. It doesn't show the 9 trades that lost money. It doesn't show the tax bill. It doesn't show the hours spent researching, second-guessing, and refreshing the ticker. And it definitely doesn't show the performance comparison against a person who bought a total market index fund on the same day and never looked at it again. Camille had a coworker who bought individual stocks on Robinhood and talked about it constantly. He'd made about $4,000 on a biotech trade in March and lost $6,000 on a tech position by July. Net result? Negative $2,000, but the $4,000 gain was the story he told at lunch. The $6,000 loss was a topic he avoided. This pattern has a name: survivorship bias applied to personal experience. The wins are visible, the losses are silent. Over any meaningful time horizon, a total stock market index fund captures the average return of the entire market, which beats most individual stock pickers because it doesn't incur the transaction costs, tax drag, and behavioral mistakes that active trading guarantees. Myth 3. The market needs to be timed correctly. The belief that there's a right moment to start investing is the single most destructive delay mechanism in personal finance. People wait for a dip. They wait for a correction. They wait for stability. They watch the news and think, maybe next month. And while they wait, the market trends upward at roughly 7 to 10% per year on average over long periods. The waiting feels prudent. It feels like caution. It is the most expensive form of caution available. A study published by Charles Schwab examined the outcomes of 5 different investing strategies over 20-year rolling periods. The best strategy was perfect market timing, buying at the absolute lowest point every year. The second best was investing immediately, every time, regardless of market conditions. The third was dollar cost averaging, spreading contributions across the year. The fourth was terrible timing, investing at the absolute highest point every year. The worst was staying in cash and never investing. The difference between perfect timing and immediate investing was surprisingly small, roughly 1 to 2% annually. The difference between immediate investing and never investing was enormous, often several $100,000 over 20 years. Even the person with the worst timing, buying at every single peak, still dramatically outperformed the person who stayed in cash. Waiting costs more than bad timing. The data is clear on this. Camille waited 3 days. In the grand scheme, that's nothing. But the pattern of waiting, of refreshing the app and closing it without acting, is the same pattern that costs people years. 3 days becomes 3 weeks, becomes 3 months, becomes a year where the money sat in a Roth IRA as uninvested cash, earning nothing while the market moved without it. The compound interest that would have started on day 1 starts on day 365 instead, and those lost days never come back. The cost of waiting isn't visible on any statement. It shows up decades later as the gap between what the portfolio is and what it could have been. Now, the 3 portfolios. Each uses the same 3 Vanguard ETFs, an exchange-traded fund. The only variable is the percentage allocated to each. The 3 ETFs are VTI, which is Vanguard Total Stock Market, holding roughly 3,600 American companies. VXUS, Vanguard Total International Stock, holding roughly 8,000 companies outside the United States. And BND, Vanguard Total Bond Market, holding roughly 11,000 bonds, 3 funds, the entire global market. Total cost? Between 0.03 and 0.07% per year. For context, that's roughly the price of a single cup of coffee per year for every $1,000 invested. Portfolio A. Aggressive. For someone under 35 with a long time horizon and high tolerance for volatility. 80% VTI, 20% VXUS, 0% BND. This is a pure equity portfolio. No bond cushion. It will drop harder in bear markets and recover faster in bull markets. Over any 20-year period in the historical record, this allocation has never lost money. Not once. But in individual years, it can drop 30 or 40%. That means if you have 100,000 invested, you could open the app one morning and see 66,000. That's a $34,000 drop on a screen. The person holding this portfolio needs to be the person who can watch that happen and do absolutely nothing. Close the app, make breakfast, go to work. If that sounds impossible, Portfolio B is the better fit. There's no shame in choosing lower volatility. The best portfolio isn't the one with the highest theoretical return. It's the one the investor can hold without selling at the bottom. Portfolio B, balanced. For someone between 35 and 50, or anyone who wants smoother returns and is willing to trade some growth for stability. 60% VTY, 20% VXUS, 20% BND. The bonds reduce volatility significantly. In 2020, when the pure equity portfolio dropped roughly 34% in March, a 60-20-20 allocation dropped about 22%. Still painful, but survivable for more people. The bonds don't add growth, they add sleep. Over 20-year periods, this allocation has historically returned between 7 and 8% annually, which is slightly lower than pure equity, but with substantially less turbulence. If you've been through a market crash before and know what it felt like to watch the numbers fall, this is the portfolio designed for people who remember that feeling and don't want to test their resolve again. Portfolio C, conservative. For someone over 50 within 15 years of retirement, or anyone who needs stability above growth. 40% VTI, 20% VXUS, 40% BND. The heavy bond allocation means smaller drawdowns but lower long-term returns. Over 20-year periods, this portfolio has returned roughly 6 to 7% annually. It's slower. But for someone who needs to access the money within the next 10 to 15 years, the reduced risk of a major drawdown right before withdrawal is worth the trade-off. Camille is 30. She went with Portfolio A, 80% VTY, 20% VXUS. She typed VTY into the Fidelity search bar on a Thursday afternoon during her lunch break at the lab, clicked buy, entered the dollar amount, confirmed. Then did the same for VXUS. The whole process took about 8 minutes. The money that had been sitting in cash for 3 days, losing ground to inflation, was now invested in roughly 4,600 companies across 30-something countries. She set the monthly transfer to auto-invest in the same 80-20 ratio and closed the app. She told me later that the feeling wasn't excitement. It was closer to relief, like finally mailing a letter that had been sitting on the counter for a week. The task was simple, the delay was the hard part, and the delay was over. There's a detail in Camille's story that connects back to Adriana from the last video. Adriana's 5 rules included automate before you see it. Camille's auto-invest setting is that rule in action. Every month on the 1st, Fidelity pulls $200 from her Ally checking and buys VTI and VXUS in the 80-20 split. She doesn't log in to do it. She doesn't decide each month whether to invest. The decision was made once on a Thursday during a lunch break. Everything after that is automatic, and that's the point. The best investing system isn't the one with the highest return. It's the one that runs without requiring the investor to show up every month and remake the same decision. There's one more number that needs to be in this video because it's the number the financial industry hopes most people never calculate. The fee comparison over 30 years. If Camille invests $300 a month for 30 years in these 3 ETFs at a combined expense ratio of roughly 0.04%, the total fees she pays over 3 decades are approximately $1,200. If she invested the same amount through an advisor charging 1%, the total fees over 30 years would be roughly $68,000. Same contributions, same market returns. One costs $1,200, the other costs $68,000. That difference alone, reinvested, is worth over $90,000 at retirement. Not from better performance, from lower cost. If you're currently paying an advisor 1% or more, pull up a compound interest calculator tonight and run the numbers on what that fee costs over your remaining investing years. The result will make the decision for you. The 3-fund portfolio has the lowest cost middleman available, and the boring truth of investing is this: the less the middleman takes, the more the investor keeps. That's it. That's the entire edge. Every person in this series arrived at the same destination through different doors. Leo and Nate, Nina, Adriana, Ray, Daniela, the surgeon, Marcus, Jess, the compliance officer. All of them, regardless of income, city, or debt level, eventually need an answer to the same question. What do I actually buy? The answer, for roughly 90% of people, is 3 funds: VTI, VXUS, BND, in a ratio that matches the time horizon. At a cost so low it rounds to 0. The financial industry has spent decades convincing people that this question is too complex for them to answer alone. It isn't. The answer fits on a sticky note. The same sticky note, incidentally, that Adriana taped inside her kitchen cabinet in the last video. Different note, same principle. Simplicity wins. But here's the part that's worth sitting with as this video ends. The simplicity of 3 funds doesn't mean the journey is simple. The portfolio will drop. It will drop hard, probably multiple times over a 30-year period. There will be months where the balance falls by 5 figures. There will be headlines screaming that the market is collapsing. And in those moments, the only thing standing between the investor and a catastrophic sell decision is the conviction that the math works over time, and that every decline in the historical record has been followed by a recovery. That conviction can't be purchased. It can't be automated. And no advisor, no matter how expensive, can provide it on the day the balance drops by 30%. That part is on the investor. The portfolio is the easy part. The behavior is everything. Next week, passive income, the internet's favorite dream, the math that makes it sound easy, and the math that actually applies. The numbers in that one are going to surprise you because the gap between the promise and the reality is wider than most people have been told.